Warren Buffett has two rules. Rule number one, never lose money. And rule number two, never forget rule number one. So let's look at AST SpaceMobile, a company with a net loss of $122.9 million in a single quarter, a company that just missed its earnings per share estimates by over 100%, a stock that on traditional value metrics is so overvalued it would make Buffett's skin crawl. By all of Buffett's rules, this stock is a pile of radioactive garbage. And yet, after that disaster of an earnings report in November 2025, the stock actually rose. The market completely ignored the miss. What the hell is going on? Today, we are doing a deep dive autopsy on one of the most volatile, high-risk, and fascinating stocks on the market. Now, a quick disclaimer, this is not financial advice. I am not your dad's broker, and this video is for educational purposes only. My job isn't to tell you what to buy, but to teach you how to analyze the battlefield. The stock is AST SpaceMobile. The mission? To build the world's first space-based cellular broadband network. Forget satellite phones, forget special terminals. The tech, which is protected by over 3,700 patents, is designed to let your normal, unmodified iPhone or Android get 4G and 5G speeds directly from space. This is the cell tower in space model. It's designed to eliminate every connectivity dead zone on the planet. The target market isn't a niche group of rich sailors, it's the 5 billion mobile subscribers who already have phones. The total addressable market is over $1.1 trillion. So, let's run the Buffett playbook. First, the circle of competence. Buffett invests in insurance, railroads, and Coca-Cola, things that are boring, predictable, and print cash. He does not invest in pre-commercial, high capital burn, story stocks that depend on successful rocket launches. Second, profitability. ASTS is a pre-revenue company. It's not making money, it's burning it. A lot of it. It's spending over $250 million in capital expenditures per quarter just to build its satellites. To a value investor, this isn't a business. It's a hole in the ground you pour money into. Third, valuation. Buffett buys dollars for 50 cents. In October 2025, analysts at Barclays and Scotiabank downgraded ASTS, calling it excessively valued and a sector underperform after it ran up 300%. On all trailing metrics, the stock is priced for a future perfection that doesn't exist yet. To Buffett, this isn't an investment. It's speculation. It's a binary bet. It's a trip to the casino. But here's the pivot. The reason the market ignored the earnings miss is because hidden in the same report was a trinity of transformative announcements that made the old bear thesis completely obsolete. First, the fortress balance sheet. ASTS just raised $1.15 billion in a convertible note offering. This brings their pro forma liquidity to over $3.2 billion. This is the most important update. The company now claims it is fully funded for its entire 100-plus satellite constellation. Think of it this way. The old bear case was they will run out of money before they can launch. That risk just got vaporized. The will they survive question was just replaced with the can they execute question. Second, the bankable contracts. The bear thesis was that their partnerships were just glorified press releases. Well, in Q3, they signed definitive, multi-year commercial agreements with Verizon and STC Group. But here's the receipt. The STC Group deal includes a $175 million cash prepayment. This isn't a promise. It's not an IOU. It is a massive, sophisticated telecom company giving ASTS a ton of cash up front for a service that isn't even fully live. This is the single greatest validation of the technology and the business model. The company's total contracted backlog is now over $1 billion. Third, the smart money moat. Buffett loves a moat. ASTS's moat isn't just its patents, it's its partners. AT&T, Google, and Vodafone aren't just passive investors, they are strategic collaborators. Google is helping integrate the service into Android, AT&T and Vodafone are placing purchase orders. This B2B2C model is brilliant. ASTS doesn't have to spend a dime on marketing. Their partners, the Verizons and Vodafones of the world, will sell the service for them. The theoretical customer acquisition cost is zero. So, the entire investment case for ASTS has been reset. The financial risk is gone, the commercial risk is gone. The only thing that matters now is execution risk. The new plan is insane. 45 to 60 satellites in orbit by the end of 2026. But analysts are deeply confused by the math. Management claims 6 to 8 satellites per launch, But a Falcon 9 rocket can likely only hold 3 of their new massive Bluebird satellites. And the competition isn't sleeping. SpaceX and T-Mobile are in the game, Apple has its own emergency SOS, but the market is bifurcating. Apple and Starlink's current service is just text and emergency messaging. Think of it as walkie-talkies versus a data center. ASTS is the only pure-play company with proven 4G and 5G speeds up to 120 megabits per second, aiming for true broadband. So, would Warren Buffett buy ASTS? Absolutely not. He'd wait 10 years until it's a boring regulated utility, and then he would buy the whole company. But for a speculative investor, the game has changed. This is no longer a conceptual play, it's an executional one. The Q3 announcements just bought the company a fully funded ticket to the final battle boss. And right now, the fundamentals and the technicals are aligning. The stock just pulled back to a classic buy the dip zone right as the company's financial risk evaporated. So I have to ask, what do you think? Is this the inflection point for a new $1.1 trillion market? Or is this a high-tech math problem that's doomed to fail? Let me know your analysis in the comments. This has been a high-speed autopsy. Class dismissed.